Hey everyone, Drew Creekmer here, Wealth Advisor for Creekmer Wealth. Hope you guys are doing well since the last time we chatted. And in today's video, I want to talk about a high-level synopsis of a summary and a study that just came out from the retirement researchers at Morningstar. It's a great study, and the title of the study is "What's a Safe Retirement Spending Rate for the Decades Ahead?" And as many of you are aware, one of the cornerstone rules of thumbs that originated in the 1990s was the 4% withdrawal rule. At a high level, this simply states that if you withdraw 4% of your portfolio every single year, you will not run out of money. And that rule has been generally a very good starting point for retirees. Well, what Morningstar did is they took a look at what the forward-looking returns look like for bonds and stocks. And they also looked at what does the forward-looking inflation rate look like for bonds and stocks. And what they found is something that we're all aware of. One, inflation is historically low. However, it is rising month over month, and we are now at a 30-year high on the month-over-month reading. The annualized average inflation rate is still historically low, but if we project things out to the future, it is reasonable to expect, with the Federal Reserve trying to get inflation to be higher on average over a 12-month period, that inflation may be higher in the decade ahead than what it has been in the last 2 decades. And so that is reasonable to expect. They also dove into the reasonable expectation that returns for stocks may be lower in the future than what they have been over the last decade. Now, we've seen great returns over the last decade, which has been a massive benefit for many of you. However, researchers tend to believe that with valuations at all-time highs, it is reasonable to expect that returns may be slightly lower in the decade ahead, ranging somewhere in the 6 to 11% a year rate of return. On the bond side of things, it is absolutely believable for all of us to believe that bond returns are not going to be on the same level as they have been in decades past. And there are a lot of reasons for this. Me and John have dove into this in past episodes, but at a high level standpoint, here's some of the reasoning for that. One, interest rates are at historic lows, which means that bonds are not paying nearly as much interest as they have in years past. Two, and with inflation going up and an economy that is starting to show very strong signs of recovery, it's important to recognize that the Federal Reserve is going to be doing things in the near future that are going to be a negative impact on bond prices, meaning they're going to raise interest rates. And when interest rates go up, bond prices go down. They also are going to stop purchasing as many bonds in the open market. They're going to begin tapering their quantitative easing program, which also will cause interest rates and yields to go up. And typically when that happens, that is not good for the price of bonds. And now you need to own some bonds in your portfolio. However, we have reduced bond exposure in portfolios and use other hedging options to reduce portfolio risk, because we do not believe that bonds are going to generate a return in your portfolio that's going to be substantial enough to justify holding a larger percentage of them. But what does this have to do with retirement spending? Well, if you're not earning as much on your stocks and bonds and inflation is higher, well, that means that your dollar, you need to be more conservative with it. And Morningstar says that they believe that the new cornerstone starting point for a safe withdrawal rate is 3.3%. Now, again, that's a rule of thumb. And who knows? Projections are just that. They're projections. They're guessing. Who knows what the future holds? However, it's important to recognize and take a look at your spending habits. And it's also important to consider how we at Creekmer Wealth structure income plans. We use a mindset called flexible retirement spending. And Morningstar dives into this in their article, which is why I'm sending it out to you. But this is at the cornerstone and the basis of how we construct your retirement income plan at Creekmer Wealth. We see a strong correlation between using logic and reason and not just setting a static spending amount in retirement. So, for example, whenever markets are up, I've told some of my clients this, I know John has as well, and our other advisors have, which is, hey, markets are doing great. Let's take some profit off the table. Let's go to a safe haven with it. Let's go to something that's guaranteed. Or, hey, why don't you spend some money to pay down debt or take that trip? Use the money that you've earned within this up market to go ahead and enjoy yourself, or to further ensure your financial future. And then when markets are down, we'll have a similar conversation. We're not saying that, hey, you can't spend any money, but are you taking out too much money? Are you starting to build up cash in your bank account? And if you are, well, then you know what? You're better off to not pull money out of your stocks. You're better off to let them ride so that you're not taking money out of stocks whenever they're down. And so there's a fine balance, there's a symbiosis, a give and take when determining what is the appropriate spending in retirement. And so at Creeper Wealth, we've built this plan over decades of doing this, and we found that it works great to actually generating long-term returns, growing your net worth without pulling out your principal. Now, we'll see what the future holds. We are tracking things very closely on a number of fronts, but we still believe and have seen strong affirmation that this mindset and philosophy will continue to work for years ahead. So I would encourage you to read the article from Morningstar. It's a great resource. It dives further into the data behind a lot of the financial planning that we do for each and every one of you. And if you have any questions, we would love to talk with you about what we have going on in your portfolio or in your financial plan. So thanks, guys, and we'll talk to you soon.